Good evening, class. Welcome to Management 330 Entrepreneurship, Spring 2016. My name is Erica Padilla, and I will be doing my presentation tonight on basic financial statements and ratio analysis. If you would please flip to page 390 to 400 in our textbook, this is what I will be reviewing. The financial planning process. There are 6 categories that go through this cycle. What is a basic financial statement? It is a summary of business financial information, which include the balance sheet, the income statement, and the statement of cash flows. The balance sheet is the assets which equal to liabilities plus owner's equity. Current assets include cash, and it has a rule of thumb to convert to cash within 1 year, within the company's normal operating cycle. Accounts receivable and inventory and fixed assets are meant to be long-term. They are intangible. Examples would be goodwill, copyrights, and patents. With current liabilities, creditors' claims against the company's assets. They are debts to be paid within 1 year, and long-term liabilities are due after the 1 year. Here's a basic example of a balance sheet. As you can see, we have assets, which include the current property and equipment, other, which comes to our total, and on the right-hand side, liabilities and shareholders' equity, including the current and shareholders' equity, and again total. The owner's equity is the value of the owner's investments in the current business. Within the income statement, it is also known as profit and loss. The calculation includes the entrepreneur recording sales for a year, including all the income that flows into the business from sales of goods and services. Others include rent, investments, and interest. Net sales revenue calculation is owners minus value of returned items and refunds from gross revenue. Cost of goods sold. The total cost, including shipping of merchandise, is sold during the accounting period. The gross profit margin is divided by net sales. Here's an example of an income statement for a basic company. We have income and expenses, which equals the net profit. What are operating expenses? They contribute directly to the manufacture and distribution of goods. The statement of cash flows is a financial statement showing the changes in a company's working capital from the beginning of the year by listing both the sources and the uses of those funds. And here is a cash flow statement. As you can see here, there is a lot that goes within this one. Cash flows from investing activities, financing activities, and lastly, net increase and decrease in cash. Creating the projected financial statements. It helps turns business goals into reality. The questions are, what profit can this business expect to earn? If the owner's profit objective is X amount of dollars, what sales level must the company achieve? And what fixed and variable expenses can the owner expect at this level of sales? Projected financial statements for a small business. With a projected income statement, it includes the sales forecast, enough capital, amount needed to start it up and keep the company going until a positive cash flow comes in, and it depends mostly on the operation, location, inventory, and also the sales volume. The projected balance sheet is developed pro forma balance sheet outlining assets and liabilities, and it also lists every asset with claims. Again, assets, cash are highly liquid, and average inventory turnover is calculated by cost of goods sold divided by average inventory level. Liabilities record for firms' current liabilities and claims. Here are my references. Thank you for watching.